Valuation isn't just the number, it's the power map for your startup. Understanding how your valuation, the amount raised, and investor ownership intersect will define everything from dilution to board control. This isn't just math, it's strategy. Today we're decoding pre-money, post-money valuation, how dilution actually works, investor ownership math, and pitfalls founders must avoid. So let's break it all down. Hey everyone, I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. This is part 2 of our NVCA term sheet series, where we unpack the building blocks of venture financing. You'll find the full playlist link in the description below. In this video, we'll deep dive into how valuation and dilution work in NVCA standard fundraising rounds, from Series Seed through Series A and beyond. Here's what we'll cover: what valuation really means, how pre-money and post-money impact ownership, how dilution happens and how to calculate it, and we'll round out with the mistakes to avoid and best practices. So what is valuation? In NVCA terms, valuation determines the price per share and the investor's ownership percentage. Pre-money means the company's value before new money. Post-money means pre-money plus the new investment amount. Investors typically reference post-money to evaluate what percentage of the business they're actually buying. So how does dilution work? When new shares are issued, everyone's ownership stake shrinks unless they invest again. To calculate investor ownership, you've got investment divided by post-money valuation, which is the percent that will be owned in the business. Founders should model dilution scenarios before signing on to any term sheet. What are the most common pitfalls to avoid? Overvaluing your company. This can scare off later investors. It may sound good in the beginning, but when you set the valuation too high, it's no different than setting the bar too high in a high jump. You're setting yourself up for problems later. The next common pitfall: ignoring dilution math. Founders often lose more control than expected. One of the key issues here is that founders do not take into consideration all of the previous safes that they've raised or any other convertible notes that may have interest that may be capitalized. Next is no benchmarking. One of the key reasons that I personally like the NVCA standard is that you avoid out-of-market terms, which can lead founders into bad situations. What are strategic implications for founders and investors? For founders, you need to know how much equity you're giving up. You need to understand future dilution scenarios. You don't want to chase a valuation specifically, you want to chase longevity, meaning you want to think about things as holistically as possible. And for investors, you need to match the valuation to the risk-reward proposition. Investors also are thinking about modeling exit scenarios based on their ownership percentages. What are best practices here? For founders, you need to be transparent about your financials. You need benchmark valuations against similar stage startups. And don't forget your next round. You need to leave room to grow, and that's tied into your valuation. You want to grow into that valuation. So let's recap. Valuation defines dilution and control. Pre-money and post-money impact ownership math. Dilution isn't evil, it's just math, and you have to understand it. You want to avoid overvaluation and unrealistic asks. You also want to think several rounds ahead, specifically in the founder context, and you want to put the hat on of how an investor might look at this in future rounds. This is part 2 of our NVCA term sheet series. Make sure to check out the full playlist below to stay ahead of the curve as a founder or an investor. And join me on the path to decoding law, technology, and innovation to grow your business. And don't forget to like, share, subscribe, and hit that notification bell. Until next time.